It is a new day, and there will be a new House. Democrats taking the majority of the House of Representatives with 219 seats. Meanwhile, Republicans keeping a majority in the Senate with 52 seats. Joining us right now is Altium Wealth Portfolio Manager, market strategist Michael Lee. Michael, good to see you. We got a rally underway. Futures indicating a 200-point rally at the start of trading. Your reaction to the midterms and what it means for markets?
You know, divided government has historically been the best playing field for stocks. So we went into this election with a fantastic economy, one that's only going to improve from here. And I don't think that thesis changed one bit. I think had the Republicans held the House, you would have gotten, you know, the chance for additional fiscal stimulus. Maybe we get some sort of infrastructure bill, but I just think there's too many moving parts and there's too much compromise involved for something like that to happen. But this being said, you had a corporate tax cut that only went into effect on the 22nd of December last year, and it really was more about tax reform and structural reform with the way business is done in the United States. Okay, the effects of that are only truly going to be seen starting in the middle of next year. We've had some short-term bump out of it, but that's going to last for many years, and we're entering what is going to be the longest business cycle we've ever had in the United States.
Yeah, I think this goes back to the notion, and markets are up now because it's digestible gridlock. But I think the most important thing that investors should focus on is that gridlock is good, but a unified government's even better, because we saw from 2016 to now what happened. We actually got fiscal policy that got us out of secular stagnation, right? Previous administration said, hey, no longer can the American economy grow at 3%, right? So get used to this lower growth environment. Well, we don't need to get used to it. But what do you see happening post 2020, right? I mean, we have a ginormous amount of entitlements that are going to start to hit the balance sheet, right? There's 60 trillion unfunded. We have a dollar that's strong right now. There's worries about a recession. What do you think happens over the next 2 years into that election with the market?
So, look, going out 3 or 4 years is very, very difficult, right? Like I was saying before, we're in a really interesting scenario right now because we're so far into the business cycle, yet there are no signs of excess. Okay, corporate balance sheets, extremely healthy. You look at credit spreads from a distance to default, we're looking almost as good as we have in the history of the S&P 500. And then you look at personal balance sheets, household net worth at all-time highs. You look at debt, household debt service payments as a percentage of take-home income. It's the lowest level in 30 years. And it seems as, you know, wages jumping. When you add average hourly wages plus additional hours worked, we're up 5.5% year over year. We've added 1,000 manufacturing jobs a day since Trump took office, or something along those lines.
So you're saying the economy's on fire and it keeps going?
Yeah, and I don't see it stopping anytime soon, regardless of what happens in Congress, unless they roll back the tax cuts. But they need 60 votes in the Senate to do that, which we know is not going to happen.
Right, so. And you made a point earlier, something that Art Hogan said about interest rates, but I just want to get this tweet out from the president. President Trump just tweeted on the midterm, so we want to tell you what he's saying this morning. He says, received so many congratulations from so many on our big victory last night, including from foreign nations, friends that were waiting me out and hoping on trade deals. Now we can all get back to work and get things done.
The president actually makes a great point, because with his strength now in the United States Senate, if you're actually going to do a long-term deal with one of these foreign nations, you have to get the concurrence of the United States Senate. And it showed, I think, strength for the president. He expanded his role in the Senate, his ability to get confirmations done and put in his cabinet secretaries was strengthened last night.
Yeah, I think that's one of the biggest stories of this midterm election, the Senate. I mean, if you wanted to win on anything, you wanted to take the Senate.
Yes.
And you wanted to increase your exposure there. Now, the Federal Reserve is meeting today and tomorrow, Mike. You made a point earlier that, look, if the Republicans took the House and the Senate, then you would have another tax cut plan, more stimulus, and that would lead the Fed to raise interest rates. What are you expecting out of this meeting today? We are not expecting an interest rate hike today, but we are expecting one in December.
Well, look, I think the Fed is on a path to normalization. I think this path to normalization is stimulative for the economy. I think rates have been too low for too long, and when the elongation of ZIRP, or zero interest rate policy, actually slowed the money supply, it crushed savers. And now that we're getting to some sort of normalized interest rates, that's helping a lot of people. It's freeing up money. And while we're nervous about Maxine Waters as the head of the Financial Services Committee, the problem with regulation is the Fed. And the Fed is looking over the loan books of JP Morgan, Wells Fargo, Bank of America. They were never in that role prior to the recession. And as a result, they basically have worked against themselves. So a lot of the effects of QE and having ZIRP were undone by the regulatory, the macroprudential.
Just so people know, ZIRP is zero interest rate policy.
Yes.
Thank you.
So the elongation of that, I think, did more damage than good. And then when you combine that with the overreach of regulation, you really took what could have been a spectacular recovery to something that was a lot more anemic. And while the president likes to criticize the Fed, I think Jerome Powell is helping the economy, not only by raising interest rates to a normal level, which I think we get there sometime in the next 12 to 18 months. Maybe the economy heats up a little bit quicker, but I think that's ultimately good.
Just to point out that the Federal Reserve rescued the anti-growth policies of President Obama's administration. And the day of reckoning for the Democrats got kicked way down the road because of the really excessive, unprecedented policies from the central bank that we don't really know what the ultimate hardcore impact would be of these anti-growth policies during the 8 years when a Democrat was in the White House.
If I could just carry off that point just super quick, the former President Obama went out on the campaign trail and he said, "Don't forget who started this." And I was saying during the break, it actually wasn't him; it was the Fed because of those restrictive policies.
But
so that's what I'm worried about, that the Fed's going to end this because they started it. So President Obama can't take credit for starting the economy. It was the Federal Reserve.
Right, of course. Right. Michael, remarks real quick.
Well, I would just say to President Obama that when you have a horrific recession like we had, you normally have a snapback growth. But we were told this is the new normal. We need to accept it. We now know that this is a new normal, and that the economy can take off when you unleash the shackles of government.
And it has 4.2% in the second quarter, 3.5% in the third quarter. Michael, it's great to see you.
Okay, thanks.
Thank you so much. Michael Lee joining us.